Investing in the stock market is often seen as one of the fastest paths to wealth. Many new investors jump in with high hopes, believing that they can turn a small amount of money into financial freedom. However, there's a huge fear that keeps many people from succeeding, which is the fear of losing everything overnight. This fear holds beginners back in many different ways. Some avoid investing altogether, while others make rash decisions based on panic, hype, or misinformation. Ironically, the fear doesn't just cause stress, it actually causes people to lose more money. So, understanding how this fear influences investment decisions is actually crucial to breaking free from its grip and achieving long term success in the stock market. So, the number one fear again is fear of losing everything overnight. Many beginners worry that one wrong investment can actually wipe out their entire life savings. They imagine dramatic stock market crashes or potentially picking a company that suddenly goes bankrupt. While this fear is understandable, especially when headlines often highlight market downturns, crashes, and financial disasters, the reality is that while individual stocks can collapse, the market as a whole historically has increased in value over time. The S&P 500, for example, has delivered long-term positive returns despite multiple recessions, wars, and financial crises. So the fear of total loss is largely driven by a short-term thinking and lack of clarity on how the markets work. Now, what this fear can actually cause, it can lead to bad decisions in the form of, let's say, avoiding investing entirely. Some people keep their money in a savings account, maybe under their bed, under their mattress, afraid to risk even a small portion in stocks. And while this feels safe, it guarantees negative returns after inflation. If they do manage to start investing, it can cause them to panic sell. And investors who fear market drops often sell their stocks at the worst possible time, locking in losses instead of allowing time for recovery. Sometimes they may over allocate into low return assets, such as bonds or gold, and while this can be good for stability, they often fail to generate wealth over time compared to stocks. Now, that was the number one fear. I'm also going to give you the number two fear, which is the fear of making the wrong picks. Another big fear among beginners is choosing the wrong stocks because nobody wants to put their money into a company that ends up tanking or ends up having nothing, which means this fear leads to hesitation. It makes you second guess, or it could make you blindly follow stock tips without doing any of your own research. This fear can cause people to jump onto hyped meme stocks instead of making calculated decisions that work for themselves. Or it can cause people to chase whatever stock is trending, hoping to ride the wave. This often leads to buying at high prices and losing money once the hype fades. It can also cause investors to overanalyze or maybe never invest at all. Some people spend months or years researching stocks, but they never pull the trigger because they're afraid of choosing wrong and losing their life savings. This leads to missed opportunities and then lost time in the market. It can also cause people to sell too soon, which means investors who are constantly afraid that they've made the wrong choice may sell at the first sign of volatility, missing out on long-term gains. Number three is the fear of market crashes. Stock market crashes are a very normal and natural part of investing, but they're extremely scary and they terrify many people. When the market takes a downturn, beginner investors often assume they should pull out immediately to protect whatever money they've gained or whatever money they have. But history shows that the market itself, the entire market, always recovers over time. For example, the 2008 financial crisis saw the S&P 500 drop by over 50%, but within a few years it had fully recovered and continued to reach new heights. Those who stayed invested saw significant gains, while those who sold out of fear locked in their losses. Now, this fear can cause mistakes and bad behavior, such as trying to time the market. Investors who try to sell before a crash and buy back in later often miss, let's say, the best recovery days, and then that drastically reduces their returns. It can also cause people to hold too much cash because being afraid of a downturn, some investors hoard cash instead of staying in the market, missing out again on long-term gains. Or it can also cause people to follow sensationalist media headlines, which, because news outlets thrive often on fear, and they often like to exaggerate downturns, many investors will end up looking at those things, make emotional decisions, making decisions based off these dramatized headlines rather than based on facts and reality. Number 4 is the fear of not getting rich fast enough. Many people who enter the stock market expecting quick, massive returns, and when they don't see it, when they don't see immediate gains, they panic or jump from strategy to strategy, hoping for a shortcut. This impatience can actually be just as damaging as a fear of loss. And this fear can actually lead to bad decisions because you're going to be chasing speculative investments where you're desperate for fast money. These beginners often invest in risky assets like penny stocks, meme stocks, cryptocurrencies without fully understanding them. It can also lead to frequent buying and selling, so instead of letting investments grow, some investors trade constantly, racking up fees and taxes that then eat into their returns. It can also cause them to ignore long-term growth. Many times people fail to appreciate the power of compound interest because it's not really fun, it's not really exciting. It does take time before you actually get anything on your returns, and then ultimately get discouraged when they don't see instant results. Number 5, how to actually overcome these fears in order to build wealth. My suggestions is number 1 here in this section is to understand the nature of risk. All investments come with risk, but the key here is to manage risk rather than avoid it, because the fear of losing everything is actually exaggerated if you take a smart, diversified approach. For example, let's say index funds, which reduce risk. Investing in broad market index funds like the S&P 500 significantly lowers the chance of a total loss while still providing strong long-term returns. Time in the market beats timing the market, so staying invested for years rather than trying to jump in and out is one of the best ways to grow wealth. Diversification is also a key thing to remember because spreading investments across multiple industries, assets, and even international markets helps protect against major losses. Number 2, separate emotions from investing. Emotional decisions lead to losses. The best investors follow a plan rather than reacting impulsively to market movements. Have a long-term mindset in this case and accept that there's going to be ups and downs, but staying invested will lead to growth over time. You should also ignore short-term noise. Headlines and stock tips can create panic, but successful investors focus on fundamentals, not hype. You should also plan to automate investments. Setting up automatic contributions to an investment account ensures consistent investment without human emotions. And then number 3 here is make sure that you learn from history. The stock market has survived world wars, economic collapses, and financial crises, but it continues to grow in the long run. So understanding historical patterns can help ease fears. For example, back in the Great Depression, we had a major stock market crash, but it eventually led to a massive recovery, something like, let's say, the dot-com crash. Again, a huge market crash, but it eventually recovered. The 2008 financial crash, the pandemic stock market crash. All of those have eventually recovered, and we are at all-time highs nowadays. So in conclusion, the fear of losing money in the stock market is natural. It's a normal thing where something important to you, you need more of it. Your whole reason for getting into the stock market is to get more of it and not lose it. So the fear of losing money is actually very normal, but letting it control your decisions is going to cost you a lot in the long run. That's about all I have for this video. Thank you so much for watching, and please subscribe.